In this video, we're continuing our strategy blueprint series where we break down how different trader types can use seasonality as a practical edge. Today, we're focusing on a trader type that sits between short-term execution and long-term investing, the position trader. Now, position traders aim to capture large directional moves over weeks or months. And because of that longer holding period, seasonality becomes incredibly powerful, not just for timing, but for shaping the entire trade idea. So let's define the trader type a little more closely. A position trader typically holds trades for several weeks to several months. They focus on macro-driven directional trends, and they're going to combine technical structure with broader market context. And they're going to prioritize risk to reward over frequency of trading. The key challenge for position traders is not just finding a setup. Instead, it's identifying when a market is most likely to produce sustained directional movement. And that's where seasonality provides a significant edge. The first and most important use of seasonality for position traders is directional bias. Before entering a trade, position traders need to ask, is this market historically trending in this direction at this time of year? And using Seasonax, you can analyze long-term seasonal patterns across decades of data if you want to. You can see here the S&P 500, and you can see straight away that from the end of March into the end of July, this has historically been a very strong period for the S&P 500 with an average return of 7.82%. You can also see here from October the 31st into the first half of December, there's been an average return of 4.08% for the S&P 500. So when you have a trade idea that aligns with a pre-existing strong seasonal trend, conviction increases and holding the trade becomes easier. Also, the probability of a sustained follow-through improves. Seasonality helps position traders avoid fighting structural flows too. Now, not all parts of the year are equal. Some periods of time consistently produce stronger trends than others. And seasonality allows position traders to identify, when markets are going to be more likely to break out, when trends historically accelerate, and when momentum is most reliable. You can see here at the S&P 500, you look from the end of July through to the start of October, that the average return has only been 0.12% over the last 10 years. So you can see that this seasonal period tends to be very weak, and there was some outsized falls of greater than 10% in 2022 and greater than 5% in 2023. So just as important as finding strong periods, it's also about avoiding weak periods of time. And seasonality highlights windows where markets historically range rather than trend, produce false breakouts, or just lack follow through. Take a look at this example here for corn. Look at this weakness. An average return of negative 11.75%, a 90% losing trade outlook. And this has been over the last 10 years. So you could really see if you had a technical position or a bias to go long corn at the coming into the middle of June, you can see that seasonality really would not support that move. And recognizing when not to enter for position traders, that can help avoid low quality environment entries. It can reduce drawdowns, improve capital efficiency, and can prevent overtrading. And sometimes the best trade is just simply not being in the market. Position traders also need to account for major macro events. Now, these include central bank decisions, inflation data, employment reports, and geopolitical developments. And using Seasonax's event feature here, you can see typical market reactions over events. So here's a Fed meeting, and you can see this is a typical market reaction of the NASDAQ, right, over the last 79 Federal Reserve interest rate meetings. We can also look at other events like CPI. You can see this is the reaction of the Nasdaq over the last 118 CPI reports. Very useful, and this helps traders decide whether to hold through events, maybe reduce exposure, or position for volatility expansion. Now, stop loss placement is one of the most challenging aspects of position trading because stops need to be wide enough to withstand normal volatility, but controlled enough to control and protect capital. And what seasonality really helps here is by showing typical drawdowns within seasonal trends, also showing historical volatility ranges and normal adverse excursions. So this was a seasonal trend that I used fairly recently, benefiting from the recent bull run we've seen in silver. I was looking to go long silver, looking for a good timing, and I can see here that Seasnax gave a great seasonal window here. Over the last 15 years, from the 30th of June to the 4th of September, there was a tremendous strength, average return 6.86%, 60% winning trade percentage, and there was a clear buy bias in the seasonal data. So when combining that with a macro buy bias that was already really strong, with the gold-silver ratio hitting over 100 at the time, that really gave me a high conviction opportunity to buy silver. And what was really helpful was look at the maximum drawdown. You can see when there'd been a positive year, so when there was a negative year, you can see the max drawdown here, 9.25, 9.68, 10.24. But look at the maximum drawdown when there was still a positive year. So you can see here was a maximum drop of 7.22%, but look at the profit, it was still positive. So the maximum drawdown that there have been over the last 15 years when there was still a profitable year was 7.22%. How helpful is that? You could just see from a seasonal perspective that a fall of 7.22% could still be profitable. So maybe that would have been a decent stop loss placement for silver, particularly if you're combining that with another technical level or a strong general macro outlook. Already you can see what a great stop placement seasonal data gives you. So the real power of seasonality comes from combining it with macro analysis, technical structure, market sentiment, and seasonality answers this key question: is this the right time of year for this trade to work? And when seasonal bias aligns with macro and technicals, trades become easier to hold, risk becomes easier to manage, and conviction improves. The key takeaway for position traders is this: seasonality is not a signal, it's a framework. It helps you identify directional bias, time entry into high probability windows, avoid low quality environments, and manage risk with historical context. So if you are a position trader, I do encourage you to explore these patterns using Seasnax and apply them to your own markets. Because the goal is not just to trade, but it's to position yourself alongside the strongest historical trends. If we take a look at copper, for instance, it's a really interesting seasonal piece with the bias for strength in copper building quite strongly in the second half of the year. So you can see here from October the 31st through to the end of the year, you can see an average return of 6.10%. So if you combine that with a bullish macro fundamental bias for buying copper, you can see actually these 2 months would be potentially excellent months to time entries.